Hi, good morning. Good morning, everyone. So welcome to our very first ever book launch webinar titled Making Your Millions in Reits by our Reits guru, none other than Mr. Gabriel Yap, who needs no introduction. So our webinar today is going to be a short and sweet one, a webinar book launch event. So our book has actually launched since about a year back, but we have not been able to do any physical event. So this is the very first book launch webinar. So, all right, just to share that, the agenda for today is just going to be an hour, where we'll start with an icebreaker session for about just 5-10 minutes. So we will have 3 books giveaways. And right after the icebreaker session, where we give away 3 prizes of 3 books, Making Your Millions in Reits, we will start Gabriel sharing on his book. And then we'll follow by the Q&A, and that's the end. It's a very short and sweet session, and we can write your Q&A on the Q&A chat box. Okay, just stand by a second device to start our icebreaker session. We will be giving away 3 books, Making Your Millions in Reits. And here you go. So I know most of y'all would have Gabriel's book by now, since it's been launched a year back. But this is the very first time we had the book launch webinar, since we can't have a physical event yet. So you may already have the books, but if you happen to win the books, you can always give it as a Chinese New Year present. What a best gift for Valentine's and for the rest of 2022, the Water Tiger year. So do have a second device prepared right now. I'm going to share screen and go into menti.com. Just hold on. Let me share screen. Okay, let's see who has logged in. Waiting for players. Okay, you just need to log into menti.com. Okay, so I will start the game right now. Okay, answer fast to get more points. What was Jeff Bezos' first job? Yes, newspaper delivery boy, a pastry chef, or a cook at McDonald's. Okay, the fastest fingers will get more points. Let's see how you did it. Wow, so that's quite equivalent 635, and the winner is cook at McDonald's. 5 people answered correctly. Let's see the score points. Question number 2. The fastest will get more points, okay? What was Warren Buffett's first job? He's a grocery store clerk, newspaper delivery boy, or he was a teacher. 3, 2, 1, time's up. Let's see whether you get it right. Wow, everybody guessed, most of you guessed correctly. He's a newspaper delivery boy. So all of you must be fans of Warren Buffett. So let's see who's the top 3 again. So CJ is the winner. Thank you so much once again. So I will bring in Gabriel very soon right now.
Good morning, everyone. Singing Kuala. I also have one question for you. That is, ladies and gentlemen, if you just sit back, ask yourself, what is the first stock that you make $1 million on? Yes, let me just repeat the question. What is the first stock that you made $1 million profit on? Well, I know some of you are still scratching your head. Okay, I'm wearing a hat, which I normally wear in my Melbourne home. Yes, we still live in Melbourne for the last 13 years now. And as a matter of fact, the reason why I wrote this book, Making Your Millions in Reits, is very simple. As I've mentioned earlier, there is really no secret in making money from REITs. Okay, so we are very curious why there are other people teaching REIT courses, charging $1,000, asking you to resort to your skill development fund to fund it. For us, we have been teaching and preaching REITs for the last 33 years. Yes, 33 years now. Because one of the reasons why I wrote this book is that I made my millions in REITs there. And then we will share with you essentially which is the questions that we can answer. Okay, so let me just go ahead now. All right. Today's I'm just going to answer in the next half an hour. This is the cost outline. There is really no secret in making millions from REITs. Okay, so don't be snooked by people who wants to sell you expensive courses on REITs. REITs is as simple as an understanding real estate. And if you're an agent or you are actually a non-Asian, you are if you invest internationally or you just invest domestically, real estate is as fundamental in any kind of investment as it can be. Okay, now then the second thing I want to actually go through with you is to how do we hunt for good REITs in our investment portfolio. Underlying this concept is very simple in the sense that do not waste time on poor REITs, bad REITs, or REITs that are trading at ugly prices because they are wasting your time, they're draining your psychology, they make you depressed. When you're depressed psychologically, as humans, we are affected. We will then make bad decisions. And this is what we at GCP Global teach in our classes, how to avoid this. Okay, so, and then I will share in the last part my personal investment journey in investing in REITs. In fact, it is actually encapsulated in my book. Just one example on Fraser Centrepoint Trust, where I was one of the top 20 shareholders for a long, long time, since its IPO in 2006 up to now. But of course, there are periodic times when I actually sell the stock, and as well as my continual classes. Now, ladies and gentlemen, our approach, as you can see, stems from my background. Okay. Now, as you can see, way back in 1992, I actually lecture for renowned institutions like Monetary Authority of Singapore, the Singapore Stock Exchange, Asian Development Bank, many of the regional banks and central banks. And as you know, many of them have sovereign wealth funds, and I actually do lecture for many of them. So you notice, therefore, our approach in investments is very thorough and very methodological and very in-depth. And this is what we bring to our REITs classes, which we have been teaching for the last 33 years. Okay, so it is actually knowing your details very well that you will notice that any whims, any nuances, any changes in REITs or other investment instruments, like for example, Jeff Bezos, Amazon, which got smashed, just the day before by 7%. Then after Amazon reported results, the share price shot up 15%. Within a day, ladies and gentlemen, if you have just bought 1,000 shares, just 1,000 shares, you are up by more than 100,000 in terms of profits. That is the underlying profitability of the US tech stocks. And that's actually another area that we have specialized in for the last 33 years. Okay. You can see, ladies and gentlemen, that we have been quoted many times. This is an interview that I gave or in the Business Times. As you can see the date, it is way back on November 1st, 2009. Okay, this is me. As you can see, ladies and gentlemen, then I was still wearing a hat. Then I look like that. I look like that now. Have I aged? This was actually 2009. So you can see, ladies and gentlemen, that I hope I have not aged much. Okay, maintain the same, simply because I'm happy. Why am I happy? Other than my beautiful wife that you have met from my family. Okay, I'm happy. You understand that you can make money. How can you do it? As you can see, ladies and gentlemen, we do not bet big. Okay, so but to bet big in our timing is one of the best ways to play, right? So essentially, this talks about the statistics of shareholding of Centrepoint Trust, and Ascendus India Trust. Okay, so you can see, ladies and gentlemen, that this is my Fraser Centrepoint Trust, where I'm the largest shareholder as number 16, and this is Ascendus India Trust. Okay, of course, in our classes, we share the reasons why, when, and why we continue to hold these stocks a big position or a small position. So as I was saying, ladies and gentlemen, one of the key things that we focus on in GCP Global in our classes is when to bet big, because the right timing will actually put you in a position to buy the REITs at the best price. And you notice that psychologically, being humans, if we buy a REIT at the wrong price, or the volatility is just too much for your character, you notice that essentially it will go down and it will actually cause you more pain than anything else. Okay, so in our journey, ladies and gentlemen, which is documented by the Straits Times, Business Times, even Cboe, which we share our methodology in detail, right? It's very academic, very thorough. So similarly, because we lecture for the various banks, various hedge funds, various institutions for the last 33 years. So we are very cognizant of what we say. Everything that we present is very well researched, so that you can make a good decision, the best decision, the best timing decision. Okay, so once again, ladies and gentlemen, after doing our homework in very detailed way, we notice that that's how we establish big positions. So for example, for Fraser Centerpoint Trust, based on the annual report in 2019, my stake then was 2.12 million shares, which in my classes 10 I've mentioned, as well as in my book, right? I've got them below the 80 cents level, and then I sold them off first time when it hit $3. Then it actually pulled back again during the COVID-19 at 160, and that's where I went in again. And when it went back up to 260 in just last year, August, I sold everything. Okay, so if you take 260 on 2 million shares, we're talking about $5 million in detail. Okay, now Sanders India Trust is the same thing. I'm listed as one of their top 20 shareholders as the third year running, as their major shareholder. So at 1.67 million shares multiplied by the share price of about 130 currently, it's worth roughly about close to $3 million. Okay, this is what we meant, right, by actually having substantive stakes, because when you move up, you can actually make millions in it. All right. So of course, in our classes, we share with you the reasons why we enter the stock. Okay. And one of the key things that we have learned over the years is this, ladies and gentlemen. One of the funds that I use to service is actually the Quantum Fund, run by George Soros. Actually, when I was working in Wall Street then, from 1996 to 1998, the person running the fund was actually no longer George Soros. It was actually his right-hand man, Stanley Druckenmiller. He was actually one of the smartest person. And right now, he still runs the Decortes Fund. And one of the things that I've learned from them is to know when to go for the jugular. The jugular is the vein on your neck. So you must know when to go technically for the kill. Okay, so you can do that for stocks, especially when they are sell down sharply. And of course, having a good understanding of psychological aspects of the market. This is where we are able to share this with you. All right. So for example, if you want to look at my video, now, if you go to YouTube, you notice we have a lot of videos under Gabriel Yap. For example, I've shared how I made 1,000%. Yes, ladies and gentlemen, 10 times on my tech investment. So in this article, in this video, I've actually highlighted Alphabet, which I actually established a position way back in 2012. Okay, so for a series of all the stocks, the investments, the timing, do go to our YouTube video as well as attend our classes. And needless to say, do actually get our book. All right, it's in there because it established the principles of making money on that. So our next tech class, if you're interested, ladies and gentlemen, is actually on the 19th of March, okay? And is entitled Investing Profitability in the FANGs, which is actually Facebook, Alphabet, Microsoft, Apple, Microsoft, Google, as well as others where like the chip companies like AMD, Intel, Micron, and last year we made it big on EVs, electric vehicles like Rivian. But of course, essentially, these stocks are highly volatile. So that's why we have a class in detail to actually guide you through, because you can double or triple, but at the same time, you also can lose, money on these stocks, as what Facebook or Meta has actually shown in their latest results on Wednesday. The underlying volatility is so sharp, so fast, that a lot of people get confused. But ladies and gentlemen, most of the time, investors are confused because why? Because we are perturbed, right? We are affected by sharp rises or sharp movement of stock prices. But really, sharp movement of stock prices is just one aspect of investment. Okay, knowing the basic business fundamentals is far more important to derive its intrinsic long-term value. It's far more important than actually knowing how the stock price move. But being human, we are affected by both, right? In fact, when we are affected by one, you will be biased towards your understanding of the long-term fundamentals. And that's where we try to focus both. We try to give you the best in our classes. Back to today's topic, right? Essentially, our approach in teaching investment is, as I've mentioned earlier, we are thorough, we're very methodological, we are very in-depth. And then we concentrate a lot on when to go in for the kill, so to speak. But as you know, and as I've shown earlier, we do not establish what we call kacang putih positions in stocks. Okay, if you're just out to make a few $1,000s, I think don't bother, right? Because investments is not about that. If you want to become wealthy, ladies and gentlemen, as of what I've shared in my book, Making Your Millions, it's watching the market closely, as what we've been doing for the last 33 years, knowing when to go in and having the courage to go in big, and more importantly, to hold on to your investments, despite so much noises in the market. So in our classes, we actually help you to decipher of that, help you to tell you which are the unnecessary noise that are affecting your market decisions, and what are the key focus that you should be looking at. Okay, right? So with our athletic experience, serving a lot of fund managers, hedge fund managers, our working in Wall Street, and as my books mentioned, I was head of institutional sales for a couple of broking houses and financial institutions before I retired. And I was also probably Singapore's youngest head of research at the age of 27 years old, way back, I think in 1992 or 1993. Okay, so we come with all the necessary experience. Okay, and we still enjoy that because, making money is, I don't know how to tell you, it's one of the most joyous joy that one can bring. But more importantly is that once you actually make this money, willing to at least share it with a lot of people. If you look at GCP Global web page or Facebook page, you notice that every year we donate money. In fact, our principal partner is Charities Foundation of Singapore, where they operate under Food Bank Singapore, Sayang Sayang Fund. If you notice in our Facebook page, we contribute and give money to these institutions, especially during COVID-19. And their thank you letters from this institution are actually pasted on our Facebook page. Okay, we don't want to actually proclaim it, because we don't want to be boasting, because it's a matter of giving. But the whole idea is that you can only give well if you can make money well, and that's what we do in our classes, to teach you to be able to do that if you are already not doing that. And ladies and gentlemen, to celebrate this, of course, I've been postponing the live book launch, but I guess I can't postpone anymore, because the Chinese version of this book, of my book, is being published, right? And is published in simplified Mandarin, which means that it can be sold in China. The biggest book publisher in China, CITIC Publishing, has published the Chinese version of this book, which means that it's available in all countries, including the US. And we want to actually buy the Chinese version for your friends or yourself, just go to jd.com. Okay, you can actually get this book and it'll be delivered to your footsteps. Okay, now the next thing I want to share with you is the why incorporate REITs in your portfolio. It's very simple, ladies and gentlemen. Okay, one of the reasons why I've written my book is because you can make millions in REITs. And I've devoted chapter 9, for example, to talk about essentially how I navigated, held on, and bought into Fraser Centerpoint Trusts, since its IPO, when to sell them when it hit above $3, when to buy back again at 160, and when to actually question the management where they make huge acquisitions like Waterway Point. There are assets like Hougang Mall, Century Square from PGIM portfolio, right? So of course, as I've mentioned in my book again, as well as what we teach in our classes, we're always very skeptical of REIT managers trying to sell you, what we call sell koyo, all right? When they make big acquisitions, they will tell you that it's going to be good, great, graphically well represented, actually enhance long-term value. Now, ladies and gentlemen, that may be true, but as a sharp REIT investor, will you basically be able to ask yourself, know whether that once that acquisition goes through, which is financed by either very cheap placements done at privately, or done by fundraising rights via a rights issue, that will lead to severe dilution. So essentially, you notice that during the crisis as of 2 years ago, and in my past video, if you go to my latest video, I've talked about why REITs have registered the worst month, for a long time in January. That was just last month. Okay, so ladies and gentlemen, you can see that this is how the market is. Okay, these are the stock market decline in the last decade alone. You can see that almost every year, right, there is an opportunity where the market decline, and therefore REITs get whacked at the same time. Okay, now this is even more opportune because you actually have a situation where the Fed is about to increase interest rates. In fact, the first one's going to come in March of this year. Whether it's going to be 4, 5, or 6 interest rates increases this year, how will the REITs market affect it? We go back and study the last rate increases between 2004 to 2006, as well as the last recent one between 2015 to 2018, and how the REITs actually affect it. Of course, this incorporates a few hours of analysis, and that's why we have classes to run that. As you can see, ladies and gentlemen, even the press tells us, and profile us that we donate our earnings. In fact, for all the classes that we've been conducting for the last 33 years, a portion, in fact, a major portion, especially during COVID-19, 100% of the proceeds that we earned, we donate to the charity. Our simple philosophy is this, right? Because we make our money from REITs, okay? And making money from REITs is not that difficult. You don't need to be too smart. In fact, if you think you're too smart and trying to be too complicated, that's where you end up losing money, right? So having the goodwill from God, I think we basically just want to donate and give to God what we think His mission for us on earth. Okay, so I don't want to dwell too much, otherwise, but you can read through it yourself. Okay, so this is again, what we have in profile, right? Our charity that we have done in the last few decades. Okay, now the underlying our class, ladies and gentlemen, and what we look for in all our classes is to pick S-REIT winners. In fact, if you read at the GCP Global website, which you can see here, right? You go to https://www.gcpglobalwebsite.com, GCP Global blogs. You can see that for every month we have publications, and every year, without fail, we pick the S-REIT winners for each year. And it's 2018, 2019, 2020, 2021. And one of the things that we notice is that, and we have empirical evidence to establish that the big S-REIT winners year after year are the ones that give you DPU accretive acquisitions, where these acquisitions really enhance the DPU of the REIT. So which are these REITs? That's what we will go through in our class next week. Okay. So this is our class for next week, ladies and gentlemen. That is to position and to buy into the best REITs for the current year. Okay, so feel free to join us for our classes where we will explain in detail all the REITs, where we talk about the winners, we talk about those REITs that should not be in your portfolio. Because remember, ladies and gentlemen, psychologically as humans, we will be affected when there are bad swings in the REIT prices of those REITs in a portfolio. We will be affected. When we are affected emotionally, psychologically, we will make bad decisions automatically, right? So this will then affect your choice of good REITs in your portfolio. So we, in our classes, help you to cut off the apron string, between yourself and the bad REITs. Okay, so we don't see the fences. We tell you whether the REITs are right for a run or something. It is actually going right for a route. If it's right for a route, this is where you should be cutting off and throwing the bad apples away. As simple as that. Okay, you can see, ladies and gentlemen, that we have been quoted very quite regularly in the press, on the big issues on REITs. So the latest issues basically is that as REIT mergers have been value destructive. So you have seen, for example, ESR REIT merger with Viva Trust previously, OUE Commercial Trust together with OUE Hospitality Trust, Escort Residential Trust and Ascendus Hospitality Trust, Fraser Lock and Fraser Commercial, Capital Land Malls and Capital Commercial. And right now we are looking at between Mapletree Commercial and Mapletree NEC and ESR together with ARA logos. Okay. In fact, afterwards we may have a Q&A, depending on how the Q&A goes. If not, I will post you one particular question where you are again have a chance to win our book if you get the question correct. Okay. So you can see, ladies and gentlemen, therefore, that even just last week we were quoted on the front page of Business Times when the market actually fell sharply, right? And you can see that last week was practically blood on the streets last week, right? And as you can see, from the headlines, regional markets fall as the Fed signals an increased rate hike. For GCP Global students who attended our classes, you know that we have forewarned you and we have actually preempted you on this more than half a year ago. In fact, if you look at our videos, YouTube videos, you can see that that's the case. And if you've been attending our classes, you notice that you have been shielded and protected from this. Okay, so what I was quoted was this again. I mean, every time a market goes down these days, the press will always be zeroing on whether it's going to be a bear market. So we, based on our experience, our thorough analysis, what I said was this, right? That interest rates increases alone, in fact, for the last few recessions since the day or since the year in which the Dow was created, that's way back in 1898, that means more than 125 years ago, have never led to bear markets. That means interest rates alone increases. Not even during the 70s. If you do remember, ladies and gentlemen, in the 70s, was where, the interest rates went to as high as 20%, just before Ronald Reagan came to become the president in 1980. So the early part of the 1970s was when oil price shot up to $80. And you notice that essentially that caused havoc in the market. But if you are a good investor or trader, this is the best time to thrive on volatility. You can still make big money. It's what George Soros' quantum fund did during the 1970s. Okay, so for those of you who can join us for our class, do join us. If not, then you can still follow us on our weekly weekly YouTube videos. So some of the recent YouTube videos I have actually is what's wrong with Mapletree Commercial Trust and Mapletree NAC merger. This video has actually hit close to about 3,000 views. I thank so many people who have been subscribers and supporting us for this, do sign up. In fact, we're running a promotion now that if you sign up to become a subscriber on our YouTube channel under Gabriel Yap, right? Do send us your name, your contact details at GCP to GCP Global, to our email rather, right, at gcpglobalsg@gmail.com. When you recommend a friend to become a subscriber and tell us the name of a friend, who is a subscriber. So then at the end of each month, we will pick a lucky draw, a winner, right? So our last video also addresses, the worst REIT market, since crash, of last week. Okay, next week, of course, we have another interesting one. Okay, so do stay tuned and subscribe to our channel. Okay, so so thank you, ladies and gentlemen. It's time for question and answer. Now, for those of you who have more questions, please type in your questions, right? And we can actually have a very lively session. That's what we do in our classes, right? As you can see earlier on, you have the interesting episode where my wife played games with you. You notice that, ladies and gentlemen, making your millions in REITs is not just so serious as what I do sound serious, right? But yes, making money is a serious matter. But at the same time, you can have fun doing it. And then when you make your money, you can also then contribute to your charity. Like, that's what we hope to establish more and more of you all like us, so that the world will be a better place. Okay. First and foremost, Mervyn, thanks for the question and Happy New Year. Mervyn say, hi Gabriel, I noticed that your REITs investment shown is only in Singapore. May I know why REITs in Australia, Hong Kong, US wasn't considered for your choice? Well, in our classes, ladies and gentlemen, Mervyn, we actually go through all the REITs investments, okay, in detail, not only just my holdings, but the key REITs that will perform well current year, next year in key markets. So for example, last year alone, Singapore REIT market did badly. In fact, we were down 6%. But guess what? The US REIT market did very well. It was up 23%. And guess what? The sector pick that we shown in our GCP Global classes, the data centers, the public storage, the public storage REITs, essentially were the ones that did very well. And this is the ones that we pick in our classes. Okay, so of course, for this half an hour session, it's difficult to show you everything, but do join us for our classes. We'll go through in detail, not only just one, but a series of them. That's why we've been doing these quarterly classes for the last 33 years. So the next questions come from CJ. CJ asks, hi Gabriel, interest rates and inflation is trending higher now. And how many local REITs responded negatively for now? What are your views on this? Thanks for the question, CJ. Again, as I've mentioned earlier, these questions were preempt and forewarned to GCP Global students more than half a year ago, right? So the interest rates moving up and inflation therefore resulting, right, is not new to the REIT market. Since the REIT market started in the US in 1960, yes, from 1960 to now, 2022, we're talking about 62 years. So whether it's actually the major REIT market in US and then Australia in 1971, Japan in 2001, Singapore in 2002, historically REITs have reacted, when interest rates move up. But guess what? While if you think that interest rates suppress the performance of REITs, then you are wrong, CJ. In fact, the last two cycles I've shown to GCP Global students between 2004 to 2006, and then in 2018, or rather 2015, 2016, where both years we have one rate increases in the month of December. Then in 2017 and 2018, we had 3 rate increases, before the Fed hit about 2.5%. And that's where the REIT market didn't perform, right? But in 2017, the REIT market in Singapore went up 32%. It was only in 2018 where it was quite lackadaisical after 3 rate increases, when essentially the of the top 10 REITs that did well, in fact, only 3 of them posted positive returns for that year, 2018. But guess what? In 2019, when the Fed ceased and stopped its rate increases, right? That means the year before the pandemic, right? In 2019, the REIT market in Singapore turned out to be one of the best performing years, where it was up 19%. So you can see, ladies and gentlemen, when it is intuitive and human, to think that interest rates will work its way into REITs and impact REITs negatively. That's what the media like to actually sell you the story. But at GCP Global, we always tell our students that we like to know what the media thinks, but not what the media, or not what many of the not so smart analysts tell you is correct, right? Because in the first place, when we have inflation, right, or in this case, it's higher than expected inflation. That's why you are having earlier interest rate increases earlier, and the number of increases, which was actually supposed to be until the second half of this year. This was in the minutes of the Fed in September last year. Now they're looking at 3, 4 rate increases for this year, right? So in fact, there's also a talk about possible 50 basis point hike in March, but I don't really think, that this is the consensus view right now. But we did tell you that, in the throughout trajectory, REIT market will be rocked at the beginning of this interest rate adjustment. Okay, once after that, then you notice that REITs have pricing power, right? So in an inflation environment, it means that GDP is doing well. That's why you need interest rates to curb this GDP, or faster than expected growth. This means that REITs, therefore, or asset owners, will sell. If you're owning REITs as well, then you notice these are the ones that have pricing power. They can raise rental. Okay, so REITs in the long term, as the episode, the last 2 rate cycles have shown, have actually done well during periods of rate increases, except for adjustment in the earlier part of the interest rate cycle. Hopefully that answers you clearly. Sean asks, Gabriel, given the recent pullback in REITs, have you seen any stabilization in the REITs market now? Sean, once the REITs actually pull back, for example, some of the big REIT names, if you look at my YouTube video, I've talked about MCT being smashed, MLT being smashed, Capital DC being smashed, right? The Sanders REIT being smashed. So in our class next week, we're going to talk about which are the REITs that are actually ripe for bargain. Okay, so on a broadly basis, there are a few things that I've been watching clearly to help Sean to actually answer whether things are stabilizing, right? So the first thing we watch closely is the Cboe Volatility Index. So that volatility index shot above 20 last week when the markets went into a higher volatility mode. In fact, it hit a high of as high as 37, right, before it started to pull back since last Friday. And as of yesterday, it's down back to below 25. Now, this phenomena was last seen in the period between 19 February 2020 and 23rd of March 2020. This was when we discovered that the pandemic, leading to a closure, right, leading to lockdowns, is going to affect the world, and that's where markets sold off. At that time, S&P sold off 37%. Our REITs market sold off 54% then and there. So that's the first thing you watch, the Cboe Volatility Index. The second thing is, of course, the 10-year bond yield. The 10-year bond yield last night, as you can see, it went up to 1.918% because of the better than expected employment numbers. It came in at 467,000 jobs compared to the market consensus of only 125,000. Of course, essentially, how it moves later on is another thing. Okay, so the consensus now, of course, is that it will hit 2%. So the market probably has discounted a 2% 10-year bond yield. But more importantly, ladies and gentlemen, I want also, and it's something that I will point out in next Saturday's class, is the fact that is the yield curve inverting? Because this episode alone, you notice that 10-year bond has moved from 1.51% at the beginning of the year now to 1.917. So today is 5th February, right? So end of last year was 31st. That was like 1 month, 5 days ago. Okay, so for it to shoot up 40 over basis points in short period of time, can create enormous volatility. And that's why we prepare our GCP Global students in our past investment classes for this. But more importantly, also the 2-year bond yield in the US has also gone up, right? From like 0.2% now to about 0.8%, which means therefore, if you take the 10-year minus the 2-year, it's becoming narrower. So if you do a 10-year, 2-year bond yield chart, you notice that that's being narrowed. In fact, in our classes next week, we show that in detail. Okay, so hopefully I do answer your question, Sean, on this. Hi, Gabriel. When will you write the book, How to Make Millions in US, China Tech Stock? Very good question nonetheless, because this is something that we've been doing all these years, okay? Because if you read, for example, our website that is at GCP Global website, you notice that I've shared earlier that I've made 10 times or 1,000% on Alphabet. Okay, there are a few other stocks that I have in my portfolio. The US portfolio, that's basically the facts, right? Of course, this quarter, my profits on Facebook has come down, because of the recent set of results. But it's not something that you have not seen before, because during the second half of 2018, because of the Cambridge Analytica problem, as well as the warning on the second quarter results, at that time, the Facebook also took a dive by about 37% then and there. And if you have gone in and buy in a big way, you can actually make good money. Okay, so essentially, for tech itself, this month alone has started very well for me, because other than Amazon shooting up well and Google or Alphabet, giving a bonus of 20 for 1 is unheard of in Singapore, right? In Singapore, you have rather crap companies, for example, like Raffles Education, consolidating 3 shares for 1 share, and yet the share price can actually fall 95%. So how to lose money in Singapore shares is the clear opposite of how to make solid money and millions in US tech shares. Okay, so for me, Google has been very good this month, and earlier the first week of this year, when Microsoft actually launched takeover on Activision Blizzard, the share price shot up from like $60 to $95, the offer price, but I settled about $90. But for those of you who are attending our tech classes, you notice Activision Blizzard, Electronic Arts, as well as Take-Two and Zinc, are the 4 stocks that we like in the gaming sector. And gaming sector is a sector that we love a lot. Okay, even though I'm not a gamer. All right. So hopefully that answers your questions. And then, hi Gabriel, could you share your views on inflation and REIT sectors that will perform best in this environment? And I'm thinking industrial REITs would outperform best due to greater inventory stocking. Is that right way to think about this? Chris, yes, you're partly correct. Other than what we will show in our classes, how the cap rates, how the valuation ratios of the REITs have changed or will change based on their latest set of results, right? You'll notice that essentially some of them are actually well prepared for that. Let me give an example. ARA logos, you notice that their industrial REITs portfolio, they are valuing many of their REITs portfolio now at a cap ratio of less than 5%. Now, boy, when we first went to live in Melbourne, and we're still living there for the last 14 years, you can easily get cap rates of industrial properties, the same kind, the same location the ARA logos are actually in, even though we live in Victoria, right? Closer to about 10 to 12%. Now you're getting less than 5%. So when we look at analysis like that, right, we notice that one of the key tenets that Warren Buffett has taught, that is margin of safety, is not there for ARA logos itself. Okay, but so when we look at, for example, the latest acquisition of MLT, basically it's 15 properties in Vietnam, as well as actually in China, as well as the 4% one in Japan. Then, of course, in our classes, we warn of this, right, to our investor students. That's why many of investor students stay out of the placement on MLT, both the private placement as well as actually the institutional, as well as actually the rights issue. And now have been able to buy it below the prices because institutional placement was done at 188. The preferential rights issue was done at 184, and the share price now is 169. So we are getting a good bargain. So if you attend our classes, you get gems like this. Okay. Hi, Gabriel. Will Fed rates and Treasury bill rate hit 2%? How do you position your rates and do you risk off? Oh, it's easy because we already have been preparing our students that the Treasury yield rate, Treasury bill rate, is number one, intrinsically very volatile, meaning that in October of 2020 to March of 2021, that means in a period of 5 months, that 10-year bond yield shot up from 0.66% to 1.7% last year. So you notice there was a mini sell-off last year, right? So we preempted that. So this time around, you can see the 10-year shot up from 1.51 to 1.916 yesterday. So over a period of just 1 month, 5 days. Again, we preempted that. So we are actually also prepping that fact that the 10-year bond yield may shoot up to 2.5%, right? So this kind of movement will actually rock any REITs portfolio, but each incremental rocking of the boat will be lesser in terms of its impact going forward, because one, the market is a forward discounting mechanism, right? In our classes, we will then, with this macro backdrop, we'll show you the various prices of the REITs that we think those are the ones that already have been sold off to the maximum value, which we think are right for your choosing, and those that are still good, but will still have some downside to go. That's what we show you in detail in our classes. The next question is, hi Gabriel, are you invested in REITs? In fact, I am the top 20 shareholder of quite a few REITs, including AIT, Ascendis India Trust, Fraser Centrepoint Trust, but of course for Fraser Centrepoint Trust, when we go in with $6 million in just one particular REIT, we sold it off and took our profits when it hit $3 in January of 2020. When it came down back to 160 during the pandemic sell-off, and then it went up to 260 again in August this year, we sold it off. This is actually documented and in our YouTube videos, as well as what we share in our quarterly REITs classes with our students. Should we vote against MCT and MNAC merger? Do take a look at my YouTube video on that. Do send us the question later on, so that we can actually answer you in detail, because we did point it out as what you have just said here, is it seems that the sponsor interest is not aligned with the minorities. This is why we came out with the video, and now when the video came out, you notice that's where MCT got sold off from $2 in December last year down to 181 currently. Okay, that happened on the first week or the second week of this year, and that's where our video came out. Okay, right. So any last questions? If not, maybe I'll have one question for you to give away the last book. Okay, right.
I have one last.
Yes, one last question.
Two more
Okay.
questions.
Gabriel, is currency risk ever a consideration for you when choosing a REIT? Of course, Chris. In fact, tax is a big issue. That's why you notice that while during the timber boom, when we actually entered a REIT called Wei House in the US, it shot up because timber shortage, was huge. I think the trading code is WE so, but if you are a Singaporean residing in Singapore or Australia, and receiving dividend from a REITs in the US, like Westinghouse or Simon Properties, you'll be taxed 30%. It's very high. Okay, withholding, right? So I went in for a trade. I don't hold it for too long. Okay, the dividends are good, but of course not as good in Singapore. But it's the capital returns is tremendous. And also, for example, like office properties over there, like Empire Office Trust, you can make a lot of money on that. In fact, if you read my book as well as attend my classes, you notice that I'm also very, very optimistic on both Chinese REITs as well as Indian REITs. But which are the ones to be choosing, when to go in, this is something that we share in detail in our classes. Okay, maybe I'll just finish the last question from AA. Say, are you bearish on FCT now, selling at 160? Look, Mr. AA, we are basically traders. We are basically investors. When to quote Keynes, it's like when the facts change, we change. Okay, so in our classes we share, why we turn bearish at 260, but we can also turn positive, when it hit 220 for Fraser Center Point Trust, because that's where it has actually come down by a lot. Okay, so in our classes we can then show evidence, because what we say, what we forecast, what we anticipate is always based on solid evidence, right? Because our trade is that we teach for the big sovereign funds, we teach for big institutions, we teach for the hedge funds, and they then, as well as we take big positions in REITs. Okay, so we don't just say for fun, ladies and gentlemen. Okay, we back up with evidence. And when you do all this severe homework in detail, that's where you bet big and make your millions. So my last question for you, ladies and gentlemen, for you to win the last book is this. Okay, now, contrary to media reports, the pending merger of ESRE and ARA logos is a beneficial merger of minority shareholders. Can you, therefore, in the next 5 minutes, okay, tell me, can you give me 3 solid quantitative or qualitative reasons why the merger will be beneficial? I will accept any reasonably crafted answers. Then I will tell you whether you can win or can win. Anybody? Counting now, 4 minutes. Okay, just to repeat, okay? Now you can see, ladies and gentlemen, that a lot of press media, in fact, just 2 weeks ago, right, this company called ISS, Institutional Shareholder Services, say that they think that, the merger between ARA logos and ESR, is not in due process. It's very interesting, because what do you mean by due process? Because ARA logos and ESR, both CEOs have come up and say that they follow the same process as advised by the lawyers, as well as actually followed by the other REITs in their previous mergers. But do they have a point? This is something that's interesting. Okay, so essentially, our question today is going to ask you that, do you share that view from ISS, or do you think, that this will be beneficial? For me, of course, I think it will be beneficial. Of course, in our classes, we'll show you evidence based on detailed calculation of return on interest, invested capital, and return on equity. Now, it's not surprising, ladies and gentlemen, that Berkshire Hathaway uses return on invested capital to calculate growth, right? Because growth for any company or REIT is based on ROIC multiplied by the investment rate. Okay, in our classes, we help you to actually calculate growth of REITs, which is based on return on invested capital plus the investment rate. Now, you have to understand, ladies and gentlemen, that the whole idea of REITs, raising money and investing in the markets, is every time they raise your capital, they pay you back dividend and they take back money from you. Okay, but are they investing in a way that benefit you as the REIT shareholder? If it doesn't, then why do you want to put more money in the REIT, right? Or you wait for it to sell off and then you actually go in and buy on the cheap, as what I did on Fraser Center Point Trust, which Mr. AA basically was asking. Mr. YJ, it is a creative is one thing, but it's not the answer we're looking for, because, ladies and gentlemen, in our classes, we always question what the REIT managers tell you as a shareholder, because based on the pro forma numbers, every merger, every every acquisition is almost positive, except for the Savannah ones. Okay, in fact, you can list with the number of hands which are the Reits mergers or acquisitions that are not positive, right? So all of them are always positive, but in actual fact, to what extent are they positive, or accretive is something to be do in our classes. For example, in our classes previously, we have shown that AIM's APAC REIT acquisition of their latest, uh, 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 supermarket in Australia, will not be accretive if they do not use perpetual securities for that acquisition. Right? So of course, if we look at the pro forma numbers, they show it positive because perpetual securities is being classified 50% as loan and 50% as equity, right? So it's practically a no-brainer to therefore show that it will be positive. But a shrewd REIT investor, you must know and be able to see through the numbers whether it is actually positive. Okay, CJ says larger REIT would potentially bring benefits such as better trading liquidity, lower cost of capital, greater feasibility to acquire larger properties to drive inorganic growth. Well, very close, CJ. CJ says better trading liquidity. That's left to be seen. Okay, because this is what they put in their trading materials, CJ. So if you look at the trading liquidity for the past REIT acquisition, for example, like Escort, Fraser Lock, it didn't really improve Fraser substantially. Okay, 2 is lower cost of capital, not really. Okay, especially now the interest rates are going to go up. But this is a reason that most REIT mergers have actually put forward. In fact, for ARA and ARA logos and ESR, it could be, there's a very high chance because of the structure that management has actually put forward. For example, kudos to the management team because they actually, when they merged and came on and merged with Viva, they expanded the number of bankers from 5 to 11 currently. So most of the bankers are giving them very good competitive rates. In fact, as a matter of fact, the cost of funds for ESR has come down from close to 4% 4 years ago now to about 2.5%. Okay, so for this merger, they have put it forward, and then they say is that feasibility to acquire larger properties to drive inorganic growth. Right? Yes, this is actually, in fact, you got more like 2 out of 3 correct. So CJ, so I think I will give the book to you. Yeah. Okay, Pauline says, are bank shares overvalued now or will they go up more since interest rates are going up? Well, Pauline, this is a different from REITs as what we're discussing of technology in our classes, but just a matter of fact, since you asked and we are more than happy to help you answer, bank shares, are they overvalued or will they go up since interest rates are going up? Well, it used to be that banks, again, the cost of funds, is actually will be impacted if interest rates go up. But that's because they are able then to the pass on to a share to the deposited holders. But you see the deliberalization of banks these days, and if we look at, for example, in the US, the results of Bank of America that came in, Citigroup, Goldman Sachs, JP Morgan, and Morgan Stanley, have shown clearly that higher interest rates actually benefit banks, not substantially, but help them in the underwriting abilities. So if you're talking about basically US banks, it says yes. On Singapore banks itself, the usual impact of interest rate increases, may not have 100% flow through for the Singapore banks. So if you're thinking of Singapore banks based on past track record, that is the case. But of course, for greater, now this is again not giving investment advice. This is just sharing you the historical of how the banks have performed during past interest rate cycle, as well as basically the recent set of results in the first 2 weeks of this year by the US banks that report so far. Okay, so hope everyone enjoyed. In fact, we will have another session like this next week, for our classes. For those of you all who don't have time to attend our classes, then of course do come up for our YouTube video. Subscribe to our Gabriel Yap, the YouTube channel. do into our articles every month. These are free. And of course, thanks again to my publisher, Marshall Cavendish, for sponsoring this particular event. And then come next month, we'll have a similar event like this, another book preview. Maybe by then we can show you the Chinese book in detail and have you a more formal session. For those of you who enjoyed this session, please tell your friends about it. Tell them how good Marshall Cavendish is. So if you want to go and write a book like what I did, do go to Marshall Cavendish. Now, if you want to make more money and become a millionaire, do join our classes. And once again, 恭喜发财, Happy New Year, everybody, from me and my wife. Yeah, cheers.
Hi. So if you would like to be updated more about our future coming events and classes, just follow us on our social media page. We have Facebook, LinkedIn, and subscribe to Gabriel's YouTube channel. All right. So we'd like to thank everyone. Have a wonderful, blessed Water Tiger year. See you. Thank you. See you soon.